Investing is like a marathon. Imagine 26 miles ahead of you and the goal in sight. You've just run out and are experiencing a mix of emotions. You are full of strength and euphoria. After a few miles, the heat becomes unbearable and you feel the first signs of fatigue, your leg ache, and you start to cramp. As time passes, doubts like, "I can't run anymore. I'd better give up. There is no point," come into your head. By the end, you are counting every yard you've run and you are exhausted. But at the end, you reach the finish line and feel an incredible mixture of joy, relief, elation and satisfaction. Yeah, it was worth it. Welcome to Invest with Jiri channel. In today's video, we will look at 5 tips that will save you a lot of money in the early days of investing. We will look at the rule of investing for the long term. We will mention the investment plan. We will look at the FOMO effect in investing, market timing and leveraged investing. Let's do this. Rule number 1. Invest for the long term. When it comes to investing, it's similar to the marathon from the beginning of the video. Not only do we experience pleasant moments when our investments grow in value and we get richer and richer, but there are also moments when the markets go against us. Every day the downturns take a percentage point of our gains and we lose ground. We feel like giving up on investing and experience despair, hopelessness and anger. Not all investing moments are pleasant. If we persevere, we will eventually reach our goal. This will fill us with a sense of satisfaction and fulfillment. I dedicated an entire Invest with Jiri channel to long-term investing because it's the serious way you can get rich. That's pretty boring and tedious way to get rich. I want to be rich now. Rule number 2. Have an investment plan, include investment horizon and investment products. Once you have a plan, you know where you are going. One is better oriented and achieves goals more easily, has patience and is disciplined. Therefore, when you start looking into the world of investments, make your investment horizon. How long you want to invest the money for. The longer, the better, of course. Ideally, we should aim for decades when we will increase the investment with regular deposits. If we are talking about investing for retirement, let's calculate how many years we have left until retirement. You should choose investment products that can be used to achieve your goal, whether you invest in bonds, stocks, dividend stocks or ETFs. You won't choose savings account at the bank to invest for 20 years. That doesn't make sense. Rule number 3. Avoid FOMO, fear of missing opportunity. I'm sure you experienced this when talking to a friend who is crazy about cryptocurrencies. According to him, it's the only way to protect yourself against the ever-present devaluation of money. We can travel around the world and with a string of words we can access digital currency from anywhere. Yes, that's true and I'm a fan of cryptocurrencies, but it's not the only way to protect against inflation and it's certainly not the golden gray of protection against other assets. Bitcoin, for example, experiences equal if not more significant declines when markets fall. So we can't even talk about fundamental diversification between assets here. A classic example of the FOMO effect is a stock price rise shoot up by 100, 200, 1000%. Recently, FOMO took place thanks to Reddit, where small retail investors bet en masse on GameStop stock growth. Netflix even made a documentary about it called Eat the Rich, the GameStop saga. Be sure to check it out. FOMO usually ends up disappointing. We jump on the bandwagon of stock price spikes late and after the trends run out, the market reverses and we experience the worst feelings of disappointment in investing. Rule number 4. Stop timing the market or speculating on the rise or fall of a traded asset, wondering if a stock will go up in a matter of seconds, minutes or hours, and then selling it at a profit may sound sexy, but if you are not in the markets from 9 to 5 every day, you'd better avoid this method of trading. The main beneficiary is your broker, who takes a small fee on each trade. Believe me, if you don't have a good strategy backed by several years of historical back testing, you have no chance in the sea of financial market sharks. You can make a lot of money in the short term, but in the long term, you have little chance of surviving with your investment account. Take a look at an excerpt from research published on the Financial Times website. New research. Success is limited until DIY investors break bad habits. It's widely accepted across the investment fraternity that the vast majority of retail traders lose money. Any seasoned investor will tell you this. In fact, more than 70% of DIY investors lose money. Rule number 5. Invest without leverage. Day trading should be avoided. This means trading financial assets on so-called leverage. What does it mean? For example, you have $100,000 and if you have leverage of 5 to 1, you can buy $500,000 worth of assets. If the markets are rising and everything is going in your favor, this can be a very good way to get rich. However, in the event of market fluctuations, which are common, your tiny account is exposed to up to 5 times leverage and you could lose your entire account with a minimum move of a few percent. If you really don't know what you are doing and don't understand the function of leverage well enough, then it is best to avoid this method of trading. I understand that it's difficult to resist the temptation of all the day traders on the internet, hundreds of thousands of dollars of profits in minutes and cocktails on flashy yachts. Know that in most cases these are just made up stories and have little to do with reality. All novice traders dream of making easy money. Perhaps one of several articles on this subject is at tradesociety.com. We can see the pyramid of most traders. 40% of them quit within a month, 80% quit trading within 2 years, after 5 years only 7% stay and only 1% profit in stock markets. What is the difference between long-term investors and short-term speculators? A long-term investor mainly wants to keep the value of his money rising above inflation, whereas a speculator chases percentage gains over the course of a day or several days by buying and selling stocks, cryptos, commodities. The long-term investor's assignment is 5 or 6% a year versus tens of percent for a speculator. A long-term investor doesn't aim for less appreciation because he is stupid or can calculate that he will make more money with more percentages. She targets asset preservation, inflation coverage and modest appreciation. He has so much capital in investments that he can easily cover his monthly annuity needs. The short-term speculator has little capital and therefore needs significantly higher appreciation in the short term and aims to get the most out of his investment. The long-term investor may not have above average income. Rather, she is a frugal person who has been used to setting aside a certain amount of her income all life and putting it into investments. They don't go on lavish vacations, buy designer clothes or drive the latest model cars. She is often a person you wouldn't know at first glance is rich. She wants to be unrecognized. We've summarized 5 basic rules That can mean you survive in a financial market and get value for your invested money. There are of course many more risks in the financial market, but the basic points are among the key ones. If I had known about and followed these rules from the beginning, I would definitely be much better off financially now. One learns and the processes are never ending, so I have no regrets. However, you have a choice and you don't have to go through all the setbacks. Investing really isn't a 100-yard race. Persevere, be patient, invest regularly, and the fruit from the trees you plant will soon turn green. Eventually you will be pleasantly surprised by the compound interest effect, which, like a snowball rolling down a slope, will start piling more and more money on top of each other. Check out my video with Matt about compound interest. I'm glad you watched the video until the end, and I look forward to seeing you in a future video. Have a great time and invest wisely.